Preparing for a financial analyst at CEZ interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at CEZ? I am interested in CEZ because it combines rigorous financial analysis with an essential, changing industry. I would enjoy evaluating generation economics, capital projects, commodity exposure, and regulatory impacts rather than analyzing a purely financial business. My strengths are structured modeling, attention to detail, and explaining conclusions clearly to non-finance stakeholders. CEZ's investments in nuclear, renewables, and grid infrastructure create long-term analytical challenges, and I would like to support decisions that improve returns, resilience, and energy security. While answering, connect your analytical skills to CEZ's electricity generation, distribution, energy transition, and regulated environment. Demonstrate awareness of Czech market relevance, operational complexity, and how finance supports investment and performance decisions. Question 2. Walk me through the 3 financial statements and how they connect. The income statement measures revenue, costs, and profit during a period. Net income flows into retained earnings on the balance sheet, while non-cash items such as depreciation are added back in operating cash flow. Capital expenditure reduces cash and increases property, plant, and equipment. Financing activities then show borrowing, repayment, or dividends. The balance sheet must balance after every transaction. For CEZ, a new power plant would affect all 3 statements through construction spending, future depreciation, and eventual operating revenue. Make sure to cover the income statement, balance sheet, and cash flow statement, explaining profit, working capital, depreciation, debt, and retained earnings. Link the statements through a simple operational example relevant to an energy company. Question 3. How would you analyze CEZ's revenue performance? I would decompose revenue into volumes, realized prices, generation mix, and other movements such as foreign exchange or acquisitions. For CEZ, I would compare actual generation and electricity sales with budget, then assess whether price changes reflect market movements, hedging, or contract timing. I would also separate wholesale, retail, and distribution-related revenue. If revenue missed plan, I would trace the variance by business unit, plant, and month, validate source data, and distinguish a temporary variance from a changed outlook. In your answer, discuss volume, realized electricity prices, generation mix, customer demand, geography, hedging, and foreign exchange. Separate operational drivers from accounting timing and explain how you would investigate an unexpected variance. Question 4. What is EBITDA, and why is it important for an energy utility? EBITDA equals earnings before interest, taxes, depreciation, and amortization. It helps compare operating performance across periods or companies because financing structures and depreciation policies can differ. For CEZ, it is useful because generation assets have substantial depreciation and long lives. However, EBITDA is not cash flow. It ignores capital expenditure, working capital, taxes, and interest. I would therefore analyze EBITDA alongside free cash flow, asset utilization, leverage, and maintenance requirements before judging performance or valuation. Be sure to mention EBITDA's calculation, exclusion of depreciation, usefulness for operating comparison, and limitations. Explain why asset-heavy utilities require additional attention to capital expenditure, maintenance, debt service, and cash generation. Question 5. How would you build a financial model for a new power generation project? I would begin with a clear operating model, capacity, utilization, availability, production, and realized power prices. Then I would forecast fuel, carbon, operating, maintenance, construction, financing, tax, and decommissioning costs. The model would include construction timing, ramp-up, depreciation, debt drawdowns, and cash flows. I would calculate NPV, IRR, payback, and coverage ratios, then test power prices, CapEx overruns, delays, and interest rates. Finally, I would document assumptions and build checks before presenting the recommendation. Focus on assumptions for capacity, availability, construction timeline, power prices, fuel costs, operating expenses, CapEx, financing, taxes, and decommissioning. Include sensitivity analysis, scenario design, and key return metrics such as NPV and IRR. Question 6. Explain the difference between free cash flow and net income. Net income is an accounting measure after recognizing revenue, expenses, interest, and taxes, including non-cash items. Free cash flow focuses on cash available after operating needs and investment, commonly calculated as operating cash flow less capital expenditure. A utility can report strong net income while generating limited free cash flow because it is building a plant or funding working capital. Conversely, depreciation can reduce profit without using cash. For CEZ, free cash flow is central to funding projects, dividends, and debt obligations. Make sure to distinguish accounting profit from cash generation. Cover depreciation, working capital, capital expenditure, taxes, and financing flows, then explain why free cash flow matters for dividends, debt reduction, and investment capacity. Question 7. How do commodity prices affect CEZ's financial performance? Commodity prices influence both the revenue CEZ earns and the cost of producing electricity. Higher power prices generally support generation margins, while higher coal, gas, or carbon prices can compress those margins depending on the plant and hedge position. I would analyze the clean spark or dark spread, expected output, and hedge coverage by period. I would also distinguish accounting gains or losses from economic exposure. Scenario analysis would show how price movements affect EBITDA, cash flow, and project value. In your answer, cover electricity prices, coal, gas, carbon allowances, production margins, hedging, contract timing, and earnings sensitivity. Explain both direct cost effects and the impact on dispatch decisions and asset profitability. Question 8. What is working capital, and what would you monitor at CEZ? Working capital represents short-term operating assets and liabilities, typically receivables, inventory, and payables. At CEZ, I would monitor collection days, supplier payment terms, inventory levels, customer deposits, collateral balances, and seasonal demand. Commodity prices and trading contracts can create large margin or collateral movements even when operating performance is stable. I would compare balances with budget and prior periods, investigate unusual aging or liquidity changes, and forecast the cash impact rather than viewing working capital only as a balance sheet ratio. Discuss receivables, payables, inventories, customer deposits, collateral, and seasonal movements. Explain how commodity trading and retail activities can create significant working capital swings, and identify metrics or reconciliations used to monitor them. Question 9. How would you assess whether a capital project creates value? I would value the project using incremental after-tax cash flows, including construction spending, operating benefits, working capital, maintenance CapEx, taxes, financing effects where appropriate, and terminal or decommissioning costs. I would discount those cash flows at a risk-appropriate WACC and calculate NPV, IRR, and payback. I would stress test delays, cost overruns, lower availability, and weaker prices. I would also consider strategic value, regulatory obligations, and alternative investments, because a positive accounting profit alone does not prove value creation. Be sure to mention incremental cash flows, NPV, IRR, WACC, timing, strategic benefits, and downside cases. Avoid relying solely on accounting earnings, and explain how you would challenge assumptions and compare alternatives. Question 10. Explain how depreciation affects CEZ's statements and valuation. Depreciation allocates the cost of a long-lived asset over its useful life. It reduces operating profit, net income, and the carrying value of property, plant, and equipment, but it does not represent a current cash payment. Therefore, it is added back in operating cash flow, while actual CapEx appears separately. Depreciation can lower taxes and create a valuable tax shield. For valuation, I would forecast CapEx and asset lives carefully rather than treating EBITDA as a complete substitute for cash flow. Focus on depreciation as a non-cash expense that reduces EBIT, net income, and asset carrying value while increasing cash flow through the tax shield. Explain why it affects accounting metrics but not directly EBITDA or unlevered cash flow. Question 11. What financial ratios would you use to evaluate an energy company? I would review EBITDA margin, EBIT margin, ROIC, and free cash flow conversion for profitability and returns. For balance sheet risk, I would examine net debt to EBITDA, interest coverage, funds from operations to debt, and liquidity. I would also monitor receivable days, CapEx intensity, and operating cash flow trends. Ratios need context. A nuclear or grid business naturally carries more assets and debt than a service company. I would compare CEZ with relevant European utilities and investigate changes over time. In your answer, organize ratios by profitability, leverage, liquidity, efficiency, and returns. Explain why interpretation must reflect asset intensity, regulation, commodity exposure, generation mix, and comparisons with appropriate peers. Question 12. How would you forecast electricity demand and generation volumes? I would combine a top-down market view with a bottom-up operating forecast. Historical demand, weather, economic activity, industrial consumption, seasonality, and customer trends would inform sales assumptions. For generation, I would model capacity, availability, planned outages, maintenance, dispatch economics, and renewable intermittency. I would reconcile the forecast with transmission or market data and management plans. I would then create base, upside, and downside cases, clearly separating demand risk from plant performance risk and price assumptions. Mention historical trends, weather, economic activity, industrial demand, seasonality, plant availability, maintenance schedules, renewable intermittency, and policy changes. Explain how you would reconcile top-down market forecasts with bottom-up operational data. Question 13. What is the impact of interest rates on CEZ? Higher interest rates increase the cost of floating rate debt and raise refinancing costs when existing borrowings mature. They also increase the discount rate used for projects, reducing present values and potentially delaying investment. Fixed-rate debt provides protection until maturity, while floating debt is immediately more sensitive. I would review the debt maturity profile, hedging policy, liquidity, and interest coverage. Higher rates can also affect customer demand and regulatory returns, so I would assess both financing and operating consequences. Cover borrowing costs, refinancing, project discount rates, debt valuation, customer affordability, and the distinction between fixed and floating debt. Explain how rates influence both reported earnings and investment decisions. Question 14. How would you analyze foreign exchange risk in CEZ's results? I would map exposures by currency and type, transaction exposure from purchases, sales, debt service, or capital projects, and translation exposure from foreign subsidiaries. I would compare revenues and costs in the same currency to identify natural hedges, then review forwards, swaps, and hedge accounting treatment. A weaker Czech koruna could increase the reported value of foreign earnings but raise imported costs. I would present both reported and constant currency performance, so management can distinguish economic changes from translation effects. Make sure to distinguish transaction and translation exposure, identify currencies relevant to revenues, costs, debt, and investments, and discuss hedging. Explain how exchange rate movements affect reported figures versus underlying economics. Question 15. What challenges do nuclear and renewable investments create for financial analysis? Nuclear projects involve very large upfront investment, long construction periods, permitting complexity, financing risk, and significant decommissioning obligations. Renewables usually have lower operating costs but introduce intermittency, curtailment, connection constraints, and merchant price exposure. I would model construction milestones, availability, degradation, operating costs, support mechanisms, and end-of-life liabilities. Because forecasts are uncertain over decades, I would use probability-weighted scenarios and sensitivity analysis rather than a single-point estimate. The investment case should reflect resilience, not only expected returns. Discuss long project lives, large upfront capex, construction risk, permitting, availability, intermittency, decommissioning, waste obligations, and uncertain market prices. Explain why scenario analysis and disciplined assumptions are essential for these investments. Question 16. How would you investigate a significant variance against budget? I would first confirm that actuals, budget versions, and reporting periods are comparable. Then I would decompose the variance into price, volume, mix, timing, foreign exchange, and one-off items. For a generation shortfall, I would speak with plant and commercial teams to determine whether an outage, lower availability, or market decision caused it. I would assess whether the issue is temporary or structural, update the forecast accordingly, and present the driver, financial impact, risk, and recommended action clearly. In your answer, describe a structured process, validate data, quantify price-volume mix effects, separate timing from permanent changes, speak with operating owners, update forecasts, and communicate actions with clear accountability. Question 17. What internal controls are important in financial analysis and reporting? Important controls include controlled data sources, documented assumptions, version control, restricted model access, independent review, and reconciliations to the general ledger or operational systems. I would maintain clear ownership for inputs and approvals, investigate unusual movements, and preserve evidence supporting reported figures. Segregation of duties is particularly important where analysts prepare forecasts and others approve them. Strong controls reduce error and improve auditability, but they also make management reporting more dependable because decision-makers can trust the underlying information. Be sure to mention data integrity, model access, version control, reconciliations, approval evidence, segregation of duties, review controls, and documentation. Relate controls to reliable forecasts, management reporting, and audit readiness. Question 18. How would you use Excel or other tools to improve financial analysis? I use Excel to build transparent models with separate inputs, calculations, outputs, and validation checks. I am comfortable with pivot tables, XLOOKUP, SUMIFs, scenario controls, sensitivity tables, and financial statement links. For recurring data, I would use Power Query or SQL to automate extraction and reduce manual errors, then present key movements in a concise dashboard. Automation should support judgment, not replace it, so I would reconcile outputs, document logic, and make the model understandable to reviewers. Discuss model structure, efficient formulas, Power Query or SQL, dashboards, automated checks, scenario controls, and data visualization. Emphasize accuracy, transparency, reproducibility, and judgment rather than merely listing software skills. Question 19. Tell me about a time you found an error in financial data. In a monthly reporting exercise, I noticed that one business unit's margin had changed sharply despite stable volumes. I reconciled the source file to the ledger and found that a formula excluded several cost rows after a column was added. I corrected the calculation, quantified the effect, informed my manager, and reran the review before distribution. I then added a range check and locked the formula section. The experience reinforced that unusual trends should be investigated before conclusions are shared. Focus on ownership, investigation, materiality, communication, correction, and prevention. Use a concise star structure, quantify the impact if possible, and demonstrate that you protected reporting quality without blaming colleagues. Question 20. How would you present a complex financial recommendation to senior management? I would start with the decision required and my recommendation, followed by the financial impact and 2 or 3 drivers that matter most. I would explain the core assumptions, show base and downside cases, and highlight risks such as price volatility, delays, or funding needs. Supporting detail would sit behind the executive summary for challenge and auditability. I would avoid technical jargon, use clear charts, and distinguish facts from judgment. The presentation should help management decide, not simply describe the model. In your answer, emphasize a clear executive summary, decision requested, key drivers, assumptions, risks, sensitivities, alternatives, and recommendation. Explain how you would tailor technical detail to the audience while preserving transparency. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.